So let's talk about how you can build a high yield dividend portfolio for 2023. Let's go. So how do you build up a portfolio? How do you start? Well, you might have some investments already, and that's great. But when you're building up a portfolio, you can either do it two ways. You can have a lump sum, or you can do it gradually and use like a dollar cost averaging. Now, dollar cost averaging is what most people do. That way you can put it into your budget, how much each month or each week, how often you get paid, how much you're going to put into your investment account, into your portfolio dividend, in order to build it up over time. Because the more that you build it up, the more dividends you're going to receive. Sometimes it can be really good if you can automate this as well. Each time money comes into your account from your paycheck, then you can put some money into your investment account. So it makes it really easy. Pretty much go in anytime. It's really difficult to try and time the market. Sure, there are better times to buy than others, but most of us don't really know when that's going to be. So just buy when you're ready. And what you're just going to do over time is just keep building up those funds. But what are you going to invest in to get those nice high dividends? Now, there's two ways you can do this. You can do this through exchange traded funds or other index funds, or you can buy individual companies. Or you can do what I do and have a combination of the two. Now, if you're just sticking to exchange traded funds, you only probably need one or two, especially if you're just buying for the high dividends. Now, you could just buy a good overall index fund. The most popular in Australia is VAS, which is Vanguard's Australian shares, and that currently has a dividend yield of 4.3%. Or you could go for a specific high yield exchange traded fund. Vanguard has one called Vanguard High Yield. It currently has a dividend yield of 5.5%. And another good high yield fund is SYI that actually had the highest yield over the last 12 months. That doesn't mean it's going to have that going forward, but it currently has a dividend yield of 7.6%. But what about if you want to buy individual companies, which can be more fun, but it's a little bit more work. Now, first you're going to think about how many companies you want to hold in your portfolio. So you want at least 10, but closer to about 15 is probably a better number. It really depends if you're holding an exchange traded fund, because that helps with diversification, or if you're just going to fill your portfolio up with high yield companies. Now, when you're diversifying, you also want to try and get different sectors as well, because different sectors react differently to different market conditions. And luckily, especially in Australia, we have a lot of high yield companies in different sectors. So it's quite easy to be able to diversify your portfolio. Now, it's a good idea to put roughly the same amount of money into each company. That's called equal weighting. Now, equal weighting just means that you don't have all of your money into one company. You've spread it out across all of the companies that you hold within your portfolio. This just helps your risk. Now, what sort of companies should you be looking for if you want a high yield portfolio? Now, obviously, you want a good yield. Now, I personally like yields of 5% or more. Sometimes I'll go a little bit lower if the company is nice and solid, but generally I like those high yield dividends. It's also important to know that the dividend yield is only important when you're buying, because once you've purchased at that price, you kind of lock in that yield, and hopefully the dividends will grow over time. So your yield will grow over time. But yield is not the only thing you should be looking for, obviously. You don't want to just get all of these nice dividends, but the company price goes down. You want both. You want capital growth and that dividend yield. So I usually stick with the ASX 200, the top 200 companies within Australia. And the reason I do this is, one, they're more established. They have a more track record. They've usually been around a lot longer. Two, they're more liquid, which means there's a lot more buying and selling going on. That way you don't get stuck within a company. Sometimes if you buy into a smaller company and there's not much buying and selling going on and the price starts to fall, it can be really difficult to get out. So going for those larger companies usually means that there's a lot more liquidity, a lot more buying and selling going on. You want to have a look and see how much they've been paying dividends over the long term. So I usually look at the last 5 years, sometimes 10 years, but usually just 5 years. Now, I want to look for consistency. I want to look to make sure that the dividends have been stable, roughly the same, and potentially growing over time. And also I want to look at the price and make sure it's going up as well. So those are the things I usually look for when I'm looking for a company to add to my portfolio. I look at dividend investing as a long-term strategy. I don't like to sell that very often. I very rarely sell. Once a year, I'll do a portfolio rebalance and I'll just have a look and see if the companies are still consistent, they're still paying dividends, they're still growing over time. I don't always buy or sell more companies during my portfolio rebalance. I'm just basically looking that everything's still on track. Now, should you reinvest reinvest the dividends or not? Now, there are pros and cons to both of this, and it depends on your goals. Now, the pros of reinvesting the dividends is that you won't be paying fees, it'll happen automatically, and you don't have to do much about it because it just happens in the background and it snowballs. The more dividends you hold, the more you'll get next time, and so on. But not every company has a dividend reinvestment plan, or sometimes you just don't want to be building up that one company. You want to spread your money across all of the companies that you hold. So you'd prefer to take the money and then choose which companies to invest in. So reinvesting really comes down to, do you want that easy growth without having to pay fees? Or do you want to actually have more control over what companies you invest in and where you want to put your money? Now, yes, you can absolutely live off the dividends if you have a big enough portfolio, and that's going to take time. So don't be discouraged, just keep building up that portfolio and it's going to snowball. The more money you have, the easier it is to build. How much you actually need is going to depend on the dividend yield of the companies within your portfolio and how much money you need to actually live. Now, a lot of people like to just supplement their income with their dividends, and others, like me, like to use that money completely to live off the dividends. Now, there are other things you need to take into consideration, whether you're living off the dividends partially or fully, and that's that you will be taxed on that dividend income. It is classified as income. Now, usually this comes down to your personal tax rate. In Australia, a lot of the dividends, especially with the bigger companies, are franked. That means that the company tax has already been paid, and that's 30%. So depending on your personal tax rate, you don't have to pay that 30%. If your personal tax rate is lower than 30%, you'll actually get a refund on that at tax time as well. So that's how to build up a high yield dividend portfolio. You're going to do it over time, and gradually your portfolio is going to grow over time as you're putting your money in, and hopefully as the stock market is also rising. And eventually, hopefully, you'll be able to get to a point where you can either live partially or fully off those beautiful dividends. Good luck with your investing, and I'll see you in the next video.